The first line is the loan line. When rates rise, floating rate mortgages, credit card balances, personal loans, business debt, and refinancing costs can become more expensive. When rates fall, monthly pressure may ease, but the total cost does not automatically become harmless. The household should list loan type, repricing date, remaining principal, payment schedule, early repayment rules, and cash buffer. Rate changes affect loans through cash flow first. The second line is the cash line. Higher rates may improve returns on deposits, money market tools, or short safe instruments. Lower rates may reduce that income. But cash is not only about yield. Its main job is liquidity, emergency reserves, optionality, and avoiding forced sales. A better cash yield is useful, but it does not turn emergency money into a speculative position. The third line is the investment line. Rates influence bond prices, equity valuation, real estate affordability, currency flows, and corporate funding costs. Higher rates often raise discount rates and pressure the present value of future cash flows, but assets react differently and markets price expectations in advance. A simple rule such as rates up means stocks down, or rates down means stocks up is too thin. Growth, inflation, earnings, credit risk, and starting valuation all matter. Break down the loan line first. A fixed-rate loan may not change immediately, but new borrowing, refinancing, or future resets still matter. A floating-rate loan may transmit changes faster. Do not only ask how many basis points changed. Ask how much the monthly payment changes, how much annual interest changes, and whether the higher payment reduces saving, insurance, debt repayment, or emergency reserves. High-interest debt deserves priority. In a higher rate environment, revolving credit and variable rate debt can consume cash flow faster than uncertain investment returns can compensate. If a household carries high-interest debt and invests at the same time, the certain interest cost must be compared with uncertain return. Reducing high-interest debt is often closer to risk management than chasing a possible opportunity. A mortgage is not only an interest rate number. Loan to value, term length, grace periods, income stability, family spending, and emergency reserves all shape affordability. When rates fall, some buyers expand their budget too quickly. If that lower rate is treated as permanent, future resets or income pressure can hurt. A safer habit is to stress test the mortgage at higher rates even when the current payment looks comfortable. On the cash line, emergency reserves come first. If rates are higher, the reserve can earn more while staying safe and liquid. But the tool must remain understandable, low volatility, and accessible. If the household locks emergency cash into long maturity, price volatility, or a product it does not understand, the reserve has stopped doing its job. Cash is useful because it is available. The second cash issue is reinvestment risk. A short-term deposit or bill may mature into a lower rate environment. Today's yield may not roll forward forever. If a retiree or household budget depends on short-term high rates, a future rate cut can create an income gap. Cash income needs a maturity map, not only a current yield quote. The third cash issue is opportunity cost. When cash yields are higher, waiting becomes less painful. The household can preserve optionality without feeling that every day in cash earns nothing. But long-term money may still need growth assets to protect purchasing power. Higher cash yield does not mean every long-term asset should become cash. Time horizon and purpose decide. Now look at bonds. Bond prices usually move opposite to interest rates, and longer duration means higher sensitivity. When rates rise, existing long-duration bonds may fall in price, while new purchases or maturing bonds may reinvest at higher yields. When rates fall, existing bonds may rise, but future income may be lower. Bonds carry interest rate risk, credit risk, and reinvestment risk. For stocks, rates are one input, not the whole story. Rates affect discount rates, borrowing costs, consumer demand, and the valuation multiple investors are willing to pay. Companies with far future cash flows may be more sensitive to discount rate changes. Companies with durable current cash flow may react differently. The investor should ask whether earnings, debt, valuation, and cash flow assumptions still make sense. Real estate sits between the loan line and the investment line. Higher rates can reduce affordability and raise financing costs. Lower rates can support purchasing power and sometimes push prices higher. But real estate also involves rent, vacancy, taxes, maintenance, transaction costs, and local supply. For a household, a home is both a place to live and a leveraged asset. Do not turn a rate cut into an automatic reason to overbid. Currency exposure needs a separate check. Interest rate differences across countries can influence currencies, but exchange rates also respond to inflation, trade, risk appetite, and policy credibility. A foreign currency deposit with a high yield may not produce a better home currency result after exchange rate moves. If the future spending need is in the home currency, foreign currency assets need stress testing. If the mortgage rate rises, how much does the payment rise? If deposit income falls, how much income disappears? If bond or stock prices drop, does it affect money needed in the next 2 years? If income falls at the same time, how many months can reserves cover? Rate risk becomes dangerous when it combines with income risk and market risk. Do not make rate prediction the center of the plan. Many people ask whether this is the last hike or the first cut. A household plan should not depend on guessing one turning point. A more durable structure controls high interest debt, leaves room in mortgage payments, protects emergency reserves, and matches investment risk with a time horizon. Guessing rates is hard. Designing a plan that can survive being wrong is more useful. Asset allocation should begin with time horizon. Money needed within months should not take large market risk only because rates are low. Money not needed for 10 years should not necessarily sit entirely in cash only because short rates are temporarily attractive. Rates are part of the return environment, but purpose, risk tolerance, and time horizon are the base layer. Retirees should watch reinvestment risk and inflation. Higher rates may make fixed income and cash tools feel comfortable, but if inflation is also high, purchasing power may not improve much. When rates fall, maturing high-yield tools may be replaced at lower income. Retirement cash flow often needs multiple sources, cash buckets, bond ladders, dividends, partial sales, pensions, or annuities. It should not depend on one rate level staying forever. Younger accumulators should avoid letting short-term cash yield absorb the entire long-term risk budget. A better return on saved cash is useful, but retirement, education, or long-term wealth goals may still require growth exposure. Keeping all long-term money in cash can exchange short-term comfort for long-term purchasing power risk. The real task is steady contribution, diversification, and tolerance for volatility. Work income can also be rate sensitive. Higher rates can increase business funding costs, cool demand, slow hiring, and affect bonuses. If the household's job income is tied to real estate, finance, technology investment, or a cyclical industry, the investment portfolio should not unknowingly concentrate the same rate exposure. Human capital belongs in the risk map. A rate cut is not automatically good news. It may reduce loan payments and support asset prices, but it may also signal slower growth, weaker earnings, or rising credit stress. Before borrowing more or taking more risk, ask why rates are falling and whether household income is secure. The economic reason behind the rate move matters. Build a three-line dashboard. The loan line lists each rate, reset date, principal, payment, and prepayment option. The cash line lists reserve months, instrument, maturity date, and liquidity. The investment line lists bond duration, equity valuation sensitivity, currency exposure, and whether money needed soon is exposed to volatility. Updating this dashboard quarterly is more useful than reacting to every headline. Set an action order. First, protect monthly cash flow, payments, reserves, and necessary expenses. Second, manage high interest or variable rate debt. Third, check whether investment risk matches the time horizon. Fourth, Consider allocation changes if the rate environment has changed the role of an asset. If the order is reversed, the household may make portfolio moves before solving the cash flow problem. Rate changes affect different households differently. A borrower with a floating mortgage feels the move differently from a debt-free saver. A retiree with maturing deposits differs from a young worker building assets. A long-duration bondholder differs from a short-term cash holder. A household spending in local currency differs from one holding large foreign currency assets. Ask which line is sensitive before asking what the market will do. Consider 3 households. Family A has a floating mortgage and little cash. A rate rise mainly means payment pressure and reserve risk. Family B has no debt and large short-term deposits. Higher rates improve income, but reinvestment risk matters later. Family C owns long bonds and expensive growth assets. The key issue is price sensitivity and whether near-term spending is exposed. One rate event has 3 different answers. Add a distinction between certain cost and uncertain price. Debt interest is a relatively certain outflow. Market return is uncertain. When the household has both high-rate debt and volatile investments, calculate the certain outflow first. This prevents optimistic return assumptions from hiding real debt pressure. Use an interest rate calendar. Put loan reset dates, deposit maturity dates, bond maturity dates, insurance payments, tax dates, and large planned spending on one annual page. Rate risk often arrives through dates, not only through headlines. The calendar lets the family prepare cash before a notice arrives. Read rates together with inflation. A higher nominal rate may still be weak if inflation is high. A lower nominal rate may be acceptable if inflation falls too. The household should care about purchasing power, after-tax income, and real payment burden, not only the posted rate. Separate safe money from investment money. Safe money is for liquidity and stability. Investment money is for long-term return and can accept volatility. Higher rates may make both accounts look similar for a while, but their jobs remain different. Lower rates do not justify making emergency reserves risky. Check total leverage. Mortgage debt, auto loans, personal loans, margin debt, and business borrowing all amplify rate changes. One loan may look manageable alone, while the combined exposure is fragile. The loan line should list every rate-sensitive liability. Do not treat short-term rates as a long-term return promise. Today's cash yield may be a cycle point, not a permanent plan. Short tools can manage a waiting period, but they do not automatically replace a complete investment plan. A household discussion can start with 3 questions. If rates rise again, which loan hurts most? If rates fall, which cash income disappears? If markets reprice because of rates, is any money needed within 2 years exposed to volatility? Clear answers produce better action than market commentary.